Good evening, all. This is Shay Horowitz, ShogunTrading.com. We are emailing this free video to two different servers to make sure that you get it. If you are receiving a duplicate copy, I am sorry. Please delete one of them. But we do want to make sure that you get it, and that's why we're emailing it from two different servers. A few things about the market itself, which is more important than that. We talked about how the market is consolidating and how it might break to the downside. I showed you this double top over here, lower top, and the breakdown, and the fact that we had a one wave down. Now, after the one wave down, we bounced back up, and now we're coming back down again. Make sure that you pay attention to the support level, the 1887, 1898. Let me show you the same thing on the S&P 500. And on the S&P 500, you can see the wedge shape consolidation. If you check the newsletter from last week, you'll see me talking about this. First wave down, and now we came back up. The fact that we came back up, completely normal. Bounced off support, profit taken, first wave is over, coming back up. The distance that it travels back up does make a difference. It is different. And the reason why, it shows you the aggressiveness of the trend down. If it's an aggressive trend, the market won't bounce all the way back up. If it's a mellow trend, the market will bounce a lot more. And when the market doesn't bounce up all that much, it's because the buyers don't really have that much power, and the short sellers are looking to hold the short position and possibly continue. So if we break below this level, the 1393 on the S&P 500, that means that we're continuing the downtrend. Continuing the downtrend can be quite significant. We can go 1300, we can go 1250. There's quite a bit of downside potential in this. Now, of course, Bernanke came out and he said that he needs to lower rates again, and he's not sure when he's going to lower rates again, but he could do it basically at any time. He doesn't have to wait all the way to the next meeting to lower rates. And a lot of people are afraid of the market rallying as soon as he lowers rates. Now, if everybody knows about this, if everybody's scared of it, that basically means that all the weak hands are already out. Everyone that is scared of the interest rate drop is not shorting right now. The people that are shorting right now are ones that are not scared. Therefore, they're not going to react to it. What could happen if he does lower rates is that the market will bounce up real quick, but then it will come back down. It will come back down with even more vengeance than before, because all of a sudden it will be safe to go short again, because he just lowered it. It will be safe to go short again. People will short, and will short a lot more, and you can see the market really diving. So don't be afraid of the fact that he's going to lower rates. It might actually make the market go down even faster, because the hurdle is going to be out of the way. What we're doing right now with our daily newsletter is we're basically short across the board. Let me show you some of the shorts that we're in right now. We have FTO, for example. 40.28 was our entry, and you can see that it worked really well. It went all the way down to the $34 level. We had PENN from 58.46 down to 52. That was a very nice trade. We had dry ships. Dry ships from 66.55 all the way to 55. 56. So, a nice 10-point trade in just a couple of days. We had TIFF, very nice, 40.68 as the short, and gap down, went all the way down to 34.65. The nice thing about it, there's Luke as well, from 46.83 down to 44. The nice thing about these trades is that they're taking advantage of the market itself, and that's my focus right now, is to take advantage of the market itself. If the market itself went for one quick wave down, you want to be able to catch the right trades that are going to take advantage of this drop down. And then as the market bounces back up, you want to take profits. And then when the market starts resuming the downtrend, you want to re-enter all these trades. And you want to re-enter every trade that's setting up like the market, so you can really take advantage of it. So one way to take advantage of them, of course, is individual stocks. The other way is by trading the indexes themselves. You have the diamonds. Diamonds are equivalent of the Dow Jones Industrial Average. You can basically look at this level, 125.25 or thereabout, because that will give you the continuation of this trend. You can look at the QQQQ, and 46.66 is a continuation of the trend. You can look at the spiders, and I have to correct this level. It has to be below the low of Friday, which was 139, so you want to make it 138.92 or so. So it'll continue down with the market. Basically what we're trying to do is, if the market is going to continue breaking down, if the market is going to go for a second wave, I want to be in stocks that are going to follow it. Or in indexes are going to follow it. And you can pick them and you can trade options on them if you want to, or you can short the index straight up. It's up to you. Another way to play them is by playing the ETFs. The QID, for example, that's the ultra short QQQQQ. And you can just buy it above this level. So it works exactly the opposite of the market itself. If the market is going up, this one will go down. If the market is going down, this one will go up, because it's short. It's exactly the opposite. So you can buy it as it breaks the 45.53 and ride the market with it. It will go up while the market itself coming down. One that's more straightforward, of course, is the QLD. So you are shorting with the market itself. I'd rather play the QID. Nice on the long side. Won't be a problem at all. Anyway, that's what I have for you for this week. Watch support levels on the main indexes. The S&P 500, for example, this is a major support level right at the 1380, 1393, also a major support level. One thing that you have to watch out for, if we break the 1393 and we bounce off the 1380, excuse me, fail to break it, you want to be out. Because then it's going to get dangerous. Because then it could form a double bottom and it could rally back. So that's something that you want to watch out for, and you want to exit the trade if it's not able to penetrate the lows of the last move. NDX, basically the same thing. If it fails to penetrate the 1887, you really want to watch out. You could wait for penetration of that level, which would be a safer trade as well. But we can talk about that some other time. Anyway, have a great week this week. And I'll speak to you next week. Oh, one more announcement. We are starting a new service. We're starting a new service that is going to be for intermediate day traders. Our day trading chat room is for advanced traders. It's very, very fast, very confusing for most people. So we are starting a chat room that will get you up to that level very quickly. So watch for an announcement about that service. If you're interested in it, email us and we'll email you some more information back. Have a great night. Talk to you next week.